Welcome everyone. Today is Friday, November the 14th, and the chart you see on the screen is the chance for another rate cut in December. Now, the markets are not really keen on what has been going on since the US government shutdown, since the end of the shutdown, actually. And today they're down by 1%. In this video, I'm going to go through some of the reasons why I think markets are down and my overall view on the broader markets in the US. Let's start with the US government, the end of the US government shutdown. So as you know, that was priced in. If you had a look at PolyMarket prior to Wednesday this week, PolyMarket was pricing in a 90% chance for the end of the US government shutdown to happen, before Friday. So that was priced in. And of course, you had a relief rally that started out, I would say, it was on Friday. If you had a look on markets on Friday in the last few hours, actually, if I go and use a 1 hour chart, you can see already on Friday, there was, sentiment improved, and that continued into the first, I would say, half of the week. And now sentiment has deteriorated significantly. Now, one of the reasons is because the White House came in on November 12th. It was a press release, a press conference by the secretary. And she said that it's likely that the October data, particularly for the employment figures, the employment situation, is not going to be released. So that spooked some of the market participants, and it naturally led to a sell-off. Do I think that's going to be the case? No. Let me explain why. Back on April 7th, I remember this day very, very well. April 7th, there was, I think it was a tweet on X, I don't know how, a post on X that said that there is it's likely going to be a 90-day pause for the tariffs. And this was 2 days before the actual pause. Now, the White House, particularly the secretary, came in and said, no, that's fake news. All right. I was a sucker and I actually believed it. That's how I missed that massive 9% run. So based on my previous experience on, what has been, in my opinion, you have to know how to read what the White House says. That's why whenever I see some reports and, whenever I see a bold statement, I take it with, a pinch of salt. Now, the next reason I believe that the data is going to be released is because we have Kevin Hassett saying that the October jobs report will be released without a reading on the unemployment rate. The rationale is because the way, which in my opinion is a bit crazy, the way that the BLS obtains the unemployment rate is by asking households. I think that's a bit strange because I will assume that the government has factual data. When corporations, they fire people, they already know almost in real time, okay, one person less. But apparently that's how they gauge the values. And that's one of the reasons why the market lost a little bit of confidence in the unemployment situation reports, mainly because of inaccuracies in the surveys. So apparently those surveys weren't conducted in October due to the shutdown, and of course the jobs report will include the main payrolls number, very important, but the unemployment rate will not be included for the month of October. All right, where does that lead us? Well, let's look first at the CPI. So overall, there are two key indicators that I'm going to look over the next, I would say, 2 to 3 weeks leading to the December 10, Fed meeting, where they're going to discuss whether they're going to lower their interest rate or not. So the first one is the CPI. All right, for the CPI, we actually had data from September. This is the only economic indicator that was released during the shutdown. The reason is because this was related to benefits in the US, and if this data wasn't released, that would have led to massive issues. So the BLS, called some participants, for a few days to release the data. I believe it was earlier in October. Yeah, October 24th. Now, the consensus for the CPI was that it's going to be a hot reading because you had tariffs. September is the first month, right, when we have 100% of the tariffs that Trump promised, in his agenda. August was not a month where you can see the impact of the tariffs because I would say half of August had tariffs and the other half didn't. So as the end of the 90-day tariff pause took place, you can look at August to gauge whether inflation has an impact or not. September, the reading came at 3%, which was below the consensus. And the consensus was 3.1%. So it was actually a favorable reading for inflation. And back then, if we go and have a look at the chart on October 24th, I'll use again the daily frame, the daily. There you go. October 24th, the markets, they actually had a big gap in the pre-market session, and they ended up above 1%. The reason, again, is because this is favorable from an interest rate perspective. So as you know, the Fed is looking mainly at true items when they decide whether to lower interest rates or not. One of them is inflation. If inflation is high, they're not motivated to lower rates because that's going to lead to even more inflation. And the other one is, the employment situation, particularly what's the unemployment rate. And that's how they determine whether to lower the rates or not. Now, the CPI was, I would say, decent. It's not low. It's still above the Fed's target of 2%, but it's still decent. If you look at the main driver for the 3% increase in inflation, that was gasoline prices. Food had nothing to do with it. New vehicles, 0.2. You had used vehicles, negative 0.4. So deflationary. Overall, I will say that the CPI for October is going to be, let's say, a figure that's not going to spook the market. And I think I have here some estimates for the CPI, right? So this is from the Cleveland Fed. And the data was actually updated yesterday, so the 13th of November. According to them, they have a nowcast, which estimates what's the CPI based on what information they have. That's going to be 3%. It's actually slightly less than 3% for both October and November. So this is key because if inflation stays at 3%, let's assume worst case scenario, 3.1%. I think the Fed is going to have a very good reason to lower the rates if the employment situation doesn't look, particularly attractive. And I think that's what's going to happen. So overall, I'm quite bullish on, I would say, between now and year's end, particularly between December 10th and the year's end. That's when I'm most bullish on the US economy. Until then, I'm a bit hesitant because first, until we have the data, until the US releases data for September, October, and you probably know that the focus right now is on November. So until we have data, I think the market is going to be, it's going to remain cautious. Another index before I continue, so this is just the chart that shows the inflation rate. If I zoom in, for example, between, the pandemic and now, you can see that you had the highest inflation in June 2022. That's when the Fed kicked in and they said, okay, we're going to raise 3 basis points, the interest rates. And that led to sentiment, as you remember in June. This is the United States Michigan Consumer Sentiment Survey. June 2022 was, I think it was the highest in 10 years. The value was 50 in the survey. So that makes sense. The Fed started to increase rates. And usually when the Fed is hawkish, the markets are cooked. That's the heuristic. Now, as you can see, the overall trend is downwards. However, since April, inflation has been ticking up from 2.3% to about 3% right now. I wouldn't say this is a low value, but I don't think it's enough to deter the Feds from lowering rates in December. Speaking of sentiment, you will be surprised to know that, since the lows in April, we had, how much we had? About 40% in the SPY, 41% increase in the SPY since the lows in April. Despite that, November, according to the University of Michigan consensus, November is as pessimistic as June 2022. And again, June was very pessimistic because the Fed hiked rates 3 basis points, in one meeting. That's quite unusual. In fact, the interest rate hike in 2022, 2023, that was the fastest hike in the history. So I don't see why the market is spooked right now, and there is a lot of pessimism in the market, given that, we had quite a decent bull run. And the only factor that I see that I perceive as pessimistic for, the broader markets is the decline, is the deterioration in data after the US government shutdown, because we're probably never going to have October. Now, this is just a chart to show you that spike in interest rates. So we went from 0.25 to 5.5% in slightly more than half a year. So February it started and it finished in August. It's more than half a year. It's a year and a few months, but you get a point. All right, PCE. This is the price consumer index and price consumption index. And this is, I would say, a more realistic view on inflation because it represents the actual basket of items that consumers are buying. As you can see, it tracks the PCI, and you can still see here an increase between April and August. So this is another metric to keep an eye on, but just mind that it tracks the CPI. All right, what happens with the thesis? So why is inflation not going to increase in October and November? All right, so why? One of the reasons is because the two main drivers that drive inflation in the US are usually transportation and housing, so shelter. Let's look at transportation. So we have the Manheim Used Vehicle Value Index. That reflects a 2% decline in October, right? And as you already know, if we go back to the CPI in August, used cars and trucks were, negative 0.4%. So that's deflation, not inflation. The index for October is 2% down. Okay, this is month over month. And compared to last year, it's pretty much unchanged. So we don't have inflation in one of the items that, as you can see in this chart, has been driving up inflation a lot in 2021, 2022. This is one item. The other item is in regards to shelter. So the national median rent dipped by 0.8% in October, and that was the third consecutive month-over-month decline. And it seems that the experts are projecting that this is likely going to continue until the end of the year. So we already have two of the most important indicators of inflation that are actually deflationary. So that's one of the reasons why I'm very positive that inflation is likely not going to be a hot reading for October. The only concern I have is that, I want to see unemployment. We need to see an increase in unemployment. And, if you look at the sentiment is quite, pessimistic right now. So this is the AAII. The last update was on the 12th of November. And you can see the predominance of bears in the market 50% bears versus 30% bulls. That's not positive, by the way. And I think that's one of the reasons why the market is overreacting to the news. And what I see here is, call me crazy, but I see a triangle, and approximately the triangle will converge on December 10th, which is quite interesting because that's when the FOMC meeting is going to take place, and Powell is going to decide on whether to cut rates or not. My projection, and I'm getting ahead because I still have to talk about unemployment, is that this is going to recover because the sell-off over the past 3 days was exaggerated. And this is going to stay in this range. Likely, the range is going to be tested on that date. If we have a decline in interest rates, this is going to continue to rally. If we don't, then this is going to be very, very bad. So that's what I see. I see hesitation, and this is already reflected in the AAII data. Fear and greed, extreme fear, buying opportunities. But the extreme fear, all right, I don't see this as being justified because we didn't have a sell-off yet. So people are very afraid that, Powell is not going to cut the rates, but hang on a second, we don't know yet. He hasn't decided. So markets are hesitant, and when there is hesitation, people tend to sell. Employment. This, in my opinion, is going to be the most important metric that you have to keep an eye on between now and December 10th. The latest data is for August. As you probably know, they didn't release the data for September, and the CPI was released because they had to calculate the benefits for, I think it's tens of millions of people in the US, which is a crazy amount. So when you look at the employment situation, all right, unemployment was 4.3%, and that was in August. Now, the report says that there has been little change since April. If we look at the charts, all right, so this is the unemployment rate in the US. Of course, you can see an increase since mid-2023, all right? So if I was to zoom in here, whilst there is indeed an increase since the mid-2023, in 2024, this has stagnated, all right? So we're over a year and a half, and the unemployment rate, it's stuck. 4.2, okay, it goes down to 4, goes down to 4.3, it's stuck. All right, so it's not continuing the upward trend leading, into July 2024. Now, I think that's about to change. So, why would unemployment, let's say, comes at 4.4 or 4.5? Why would that be bullish? Well, and actually, before I go into that, I actually want to explain why I believe it's gonna be 4.4, 4.5. So we have the Challenger report that was released on November 6th. So what we have here is the number of announced job cuts. All right. So the data for October showed 153,000 job cuts, and that was up 183% sequentially. Okay, so this is a massive increase. And you probably know, you've already seen, the likes of Amazon, many mega caps in the US getting rid of employees as they adopt AI. And by the way, many skeptics, they don't think it's AI. They think, it's because of the glut. After the pandemic, corporations started to hire people left and right because there was liquidity, and then they stopped in 2023. And now they're like, okay, we have to get rid of them because, we have to please our shareholders. So I would say that, I think AI has more to do with unemployment than the post-pandemic glut. And corporations, they don't want to admit this because, there is regulations in the US, and if the regulators, they find out that AI is actually driving to a massive increase in unemployment, then there are going to be policies that are probably not going to be favorable for the hyperscalers, for the AI revolution, for anything that has to do with building AI data center infrastructure, building chips, and the LLM companies like ChatGPT and Anthropic and so many others. So overall, I think that these companies, they are actually laying off people because of AI. And there is some skeptics that they think it's not the reason, but I don't agree with them. The reason why I think, by the way, that unemployment is going to increase is because the year-to-date job cuts are at the highest level since 2020. All right, year-to-date. So if you obtain the year-to-date figure up until October, the announced job cuts are the highest since 2020. And in fact, if you look at October, this is the highest month since October 2003. So the report shook the markets. And if you have a look at what happened with the SPY on November 6th, there we go. It was down 1%, which is not really, a massive sell-off, but I think it deteriorated the sentiment. And in fact, if you have a look at this trend right here, so this trend was broken by the news from the Challenger report. So I think this was one of the reasons that led to the pessimism. Although, I think the market is getting ahead with unemployment because it's in the short term, it's hyper positive from an interest rate perspective. In the long term, it's dangerous because it can lead to a decline in consumer spending. But in the near term, we're looking at this time frame, all right, up until the end of the year. In that time frame, an increase in unemployment, let's say 10 basis points, 4.4%, that's bullish in my view. All right, moving on, we have the ADP National Employment Report. This showed mixed data. So, for example, for October, it showed that private sector employment increased by 42,000 jobs, and the pay was up 4.5% year over year. All right, good. However, if we look at September, so this is the US ADP employment change. It's simply displayed to see the historical value of the report. September was negative 29,000 jobs. So 29,000 jobs were lost in the private sector. Prior to that, it was almost flat. And July was shown, a decent increase in the number of jobs. Now, if you look at the trends for the past 5 years, you can already see, you had the post-pandemic glut in hiring. So this is when people say AI is not behind the job cuts. Bullshit, I think AI is behind that, and I think the glut from all these hirings, employers are realizing, wait, we can grow more with less, so why hire? You can see the trend; it's very negative. So I don't think that employment is going to improve in the near term. You can see here the minutes of the the FOMC meeting. This was from back in September. And I wanted to highlight a remark that said that their expectation for the unemployment rate increased only marginally overall. Only marginally. All right, this is key. Because if the data shows a meaningful increase in unemployment, that can, I think it can be a decision mover. So if unemployment comes in 4.4, 4.5, they're going to be straight down. We have to lower the rates. Even if inflation comes in hot, even if we have a 3.2% inflation, if unemployment is, 4.4, I think unemployment is going to win on the rationale. Even though there are some, Feds that are more hawkish lately. I think the Cleveland Fed said that, they want to take it slow with the rate cuts. Now, when you look at the odds for, one rate cut in September, is about 54% in PolyMarket. It's a coin flip. And you can see it drastically declined from, before the government shutdown, which is, it was 72%. Again, I think this is dislocation between, pessimism and what is likely going to happen. So I think pessimism is taking too much weight into the decline that we have seen here. And I don't think it's justified because, again, unemployment is going to come in at a high rate. This is just from the CME group. What you have there is a decline, 50%. I think it's 50.1%. And I think that was, from today, November the 13th. And finally, when we have a look at the SPY, I like to look at the SPY. Then, of course, some people look at the Qs, and the NVX is another index to keep an eye on. In the NVX, the picture looks quite bad, and that's particularly because of the tech sell-off. I mean, if you have a look at Nvidia right now, it looks bad. Well, today they actually recovered. Okay, that's bad. That's not bad. Previously, pre-market, I think it was down low single digits. So Nvidia is holding up in this 180 support, which is very important because next week they are going to report earnings. So if they disappoint and if they break this very important support level next Wednesday, well, sell-off could be significant because the next stop will be 150 approximately. And if the pessimism continues, especially if we have the Fed deciding to not cut rates, the next stop is going to be back to 100. And that's going to be bad because Nvidia is 5%. You see, I think it's 8% of the S&P 500. And, it's a 5 trillion market cap company. NDX broke, below the trend. This is not bullish. And it's just a sign of the sell-off in the tech sector. Now, if we look at FinViz, I actually like to see the map that they have. So today it's a red day. Interesting. So today everything is down, but healthcare is not up. You see, so it's not the same as what happened over the past 1 week. If you look at the past 1 week, healthcare, consumer staples was up, energy was up as well. And you can see the tech, so consumer cyclical, technology, semiconductors, all that was down in the last week. But this chart is really interesting because if you look at what happens, each day, what are the industries that are being bought, I think it gives you a really good idea on whether there is a rotation from speculative assets to safer assets. Usually that's bad. It's good from a breadth perspective, but it's bad for what's fueling the current bull run. Back to the SPY. If we look at the 1 hour charts, okay, so far the trend looks particularly favorable. I would expect, well, it doesn't have to go up until this level. So I'm not saying that the SPY is going to necessarily recover 680, but I would expect the SPY to trade somewhere between this range up until December 10th. And I will keep a very close eye, especially if it breaks. If there is any announcement from the White House or any catalyst that can be perceived as negative, if that breaks this support line, that's going to be very bad for equities because I think the next stop is going to be 640s, and even below that, if we have a look at the highs, before March, 615 is going to be the next stop for a sell-off. So it's very important that, this stays inside, and into December 10th, this has to break upwards. If it breaks upwards, that's going to be a rally into year's end, and it's going to be very bullish. If not, very bad. So that's it for now. Let me know in the comments any questions, and I'll see you in the next one.